We're now ready to add our vehicle lease to our workbook and complete the classification and initial measurement. First, let's add it to our lease list. The identifier is 6.0. We'll call it Denver Cargo Van Lease. It's a new lease. The asset type is vehicle. The initiation date was May 15th, 2026. It commenced on June 1st, 2026. And the termination date is May 31st, 2030 for a 48-month term. Then we've elected to use a risk-free rate as our discount rate for the vehicle class of asset, so we'll assume that's 3.4%. And we don't yet know the classification, so let's look at that now. To complete this, we need the present value of our lease payments, so we'll copy over an operating lease template. We can update it if it turns out to be a finance lease. We'll copy the 2.0 lease, rename the worksheet to 6.0, update the identifier, then we can clear out our payment schedule, our right of use asset information, update our schedule to 48 periods, and then update the references in our check to the last period in our lease. Okay, now let's build out our payment schedule. Remember that we include in lease payments any variable payments that depend on an index or rate at their original value, which in our case is $1,100. Also recall that for this lease, our monthly payment occurs at the end of each month, instead of in advance. So from June 30th, 2026 to May 31st, 2030, our termination date, the payment will be $1,100. And if we just quickly look at the end of our lease schedule, you can see we're making that last payment on the termination date of our lease. As opposed to our previous leases, if we just look at our 5.0 lease and all the ones before that, for this last period in our lease schedule, at least as far as the liability is concerned, there is no activity because we make that last payment in advance of the final month. So not a big difference, just something that I wanted to point out. And then as you'll see, our 48 payments of $1,100 per month, discounted at an effective monthly rate of 0.279%, results in a present value of our lease payments of $49,353. This amount does not yet include our residual value guarantee, and that's intentional because I want to highlight how a residual value guarantee can impact our analysis. Now let's work through the classification. The lease does not transfer ownership of the van at the end of the term, and we do not have an option to purchase it. It's unlikely that a 4-year term would cover 75% or more of the useful life of a new van. In a real-world scenario, we'd want a more formal analysis, but for our purposes, we'll assume we've done that and concluded the lease term does not cover a major part of the remaining useful life of the vehicle. Additionally, the underlying asset is not specialized. It's a standard cargo van. So we've now failed 4 of the finance lease criteria, leaving only the present value test. And if we do not include our residual value guarantee, we also fail this last criterion. We have a present value of $49,353, and if we just do some scratch work to compare that to the fair value of our van, which is $57,000, you can see the present value of our future payments represents 86.6% of the fair market value of the van. Recall that we use a threshold of 90% to consider this test passed. However, this lease does include a residual value guarantee, and our analysis suggests that we are probable to owe the lessor $2,100 at the end of the term. So we need to include that expected payment in our lease payments. So we'll add it as a separate payment in the schedule on May 31st, 2030 for $2,100. That increases our total payment on that date to $3,200, which increases the present value of our payments to $51,190. So with the residual value guarantee included, the present value of our lease payments represents 89.8% of the fair market value of the van at commencement. We still do not reach our 90% threshold, so we classify this lease as an operating lease. But we're clearly very close to the line that separates an operating lease from a finance lease. So let's take a moment to step back and look at the impact of our policies, judgments, and estimates on lease accounting. I know we're focused on residual value guarantees, but this won't be too much of a sidetrack. It's easy to get lost in the numbers, but let's consider the assumptions we made. First, we determined we are not reasonably certain to exercise the renewal option. This reduces the present value of our lease payments and significantly affects our classification. If we had determined we are reasonably certain to exercise the renewal option, and the lease term was 5 years, the present value of our lease payments would increase, and we would classify this as a finance lease instead of an operating lease. Next, we elected the practical expedient to use the risk-free rate as our incremental borrowing rate. If that rate had been only slightly lower, the impact could be significant. For illustration, if we change the discount rate to 3.25%, the present value of our lease payments increases to $51,344, which is 90.1% of the fair value of the van. This would change our classification from operating to finance. Then third, we estimated that we are probable to owe $2,100 under the residual value guarantee. But this is an estimate of an amount we're expected to pay 4 years in the future. And in our case, even a change of $200 can make a big difference. If we estimated a payment of $2,300, the present value would again exceed the 90% threshold, which would change the lease classification. Now, I don't say this to make us question our work. The best we can do is put together a solid, logical, and defensible analysis. But it's important to recognize how much judgment goes into lease accounting. And this list is far from exhaustive. It's helpful to understand the impact that our judgments have, because this improves your ability to develop consistent and logical accounting policies and practices at your company under ASC 842. So now let's finish our lease. We'll change this back to $2,100, delete our scratch work down here. The contract requires a $3,000 upfront payment, so we'll include that amount in our right of use asset, and we'll classify this as an operating lease. Then let's quickly add this lease to our list of periodic journal entries. Right now our reporting date is well in the future. Let's change that back, maybe to June 30th, 2026, the first reporting date that will include our vehicle lease. And then we'll copy down an operating lease. Let's grab this 2.0 lease, update this to 6.0, then update the formula references from the 2.0 worksheet to the 6.0 worksheet, update the date references from E17 to E57, and then finally, we'll update our accounts. Our current vehicle lease liability account number is 2300-3000, and the name is Vehicle Lease Current. Then the long-term account number is 2600-3000, and Vehicle Lease Long Term. And for the accumulated amortization, 1400-3001. And it'll be accumulated amortization vehicle right of use assets. And with that, we've recorded our vehicle lease. We won't go through the initial measurement journal entry in our accounting system. We've seen that many times at this point. But we do have that information attached as files to this episode if you want to look at them in detail. So that completes our work on residual value guarantees. In the next episode, we'll tackle variable lease payments, our final topic before we begin to look at remeasurements and modifications.